Hey Bowtie Nation, Joseph Hogue here, and I love me some dividend stocks, but waiting 3 months for those dividend checks is like even waiting for those monthly dividend stocks to pay out can sometimes feel like forever. So for those of you as impatient as I am, I'm about to show you a way to turn 12 regular dividend stocks into a cash check every week of the year. It's dividend cash flow you can count on every week with an average 6.4% dividend, more than 4 times the market average. I'll show you how to set this up later, but let's get started with Cisco Systems, ticker CSCO, and its 3.2% dividend yield. I know that yield is nothing to get excited about. In fact, the payout on most dividend stocks is so small, you have to squint to see it. That's why for this list, I looked for the highest dividend yields within quality companies, so you not only get that higher cash flow, but also invest in companies you can count on. Along with the rest of the stocks in this list, the portfolio pays an average 6.4% yield. And what Cisco lacks in yield, it makes up for in consistency and reliability. The company has increased the dividend by 3.4% a year and has boosted that payout for 12 consecutive years. I'm going to show you how to find this later, but you can see here, shares go ex-dividend in the first week of January, April, July, and October of each year. Now, Cisco isn't the growthy tech company it once was. It's only growing revenue by about 5% a year, but it is a cash flow machine. The company generated over $19 billion in free cash flow last year, $6 billion of which it paid out to dividends, and $4 billion to buy back its own shares. The legacy networking giant is trying to remake itself into an AI and cloud growth engine. What I like about this is that $24 billion in recurring revenue on its products and services, sales the company can count on every single year, and the cash flow that is going to continue to pay out to investors in this first week, 4 months a year. We're just getting started, but all you out there in the nation know real estate will always have a special place in my portfolio. I got my start as a commercial property analyst, and no other asset has created as much legacy wealth as real estate. And rental property is the ultimate in cash flow, and right now, single-family rentals seem to be the only safe place in real estate. But I've owned real estate, and I can tell you, if you haven't known the joy of being woken up at 3 a.m. to light the pilot light on someone's water heater, then you haven't known the bliss that is managing your own properties. For that reason, I'm investing through the Arrived Homes platform instead. Instead of investing in a fund of properties, you get to invest directly in individual rental homes with a direct investment. You earn cash flow on the rental income with dividends from 3 to 8% on rent, and then price appreciation when the property is sold. Upside price returns have been as high as 136% over the 5 to 7 year holding period. I know you have a lot of questions. I know I did before I started investing, so I'm going to link to Arrived Homes in the description below, or just scan the QR code here with your phone. One thing though, homes available for investment sell out fast, so make sure you click through and get on that notification list. I missed out on a lot of good properties for not being on that notice list, so look for the link below. From the lowest dividend yield in the group to one of the highest, Lincoln National Corporation, ticker LNC, with its 7.6% yield. Now, before you look at the price chart on this one, brace yourself because it is nasty. Shares have fallen 67% from that 2021 high. So what's the deal? It's not like LNC and that insurance business is the kind of growth stock that exploded during the pandemic. Lincoln National is the poster child for what the Fed's fastest rate hikes in 40 years has done to this market. You see, the company collects billions in premiums and retirement products, but then has to earn an ultra-safe return on that money to make sure it's there to pay out insurance claims and withdrawals. That means it's only investing in the safest bonds, which have been slammed over the past 2 years as those rates increased. It's similar to what happened at the banks last spring, though Lincoln doesn't have that same deposit risk. Basically, the value of those assets held by the company shrank as those bond values plunged, and that took the stock down with it. But that drop in shares has become a decade low in the valuation, now trading for just 0.27 times sales and under 10 times earnings. Before the pandemic, shares typically traded on a price-to-sales ratio of more than 4 or 5 times the current valuation. But now, with the Fed pausing its rate hikes, the shares have leveled out, holding steady since last March. The company has been able to keep up its dividend. Here you see it goes ex-dividend around that second week in January, April, July, and October. Lincoln has grown the dividend at a 4% annual pace over the last 5 years and has plenty of cash flow to keep that up. And with the Fed expected to start cutting rates mid-next year, that could reverse that price pain in the shares. Even a revaluation back to 0.5 times sales would mean an 85% increase in the share price here on top of that 7% dividend yield. It's not going to happen overnight, but this is a dividend you can count on and a long-term price upside. Drug maker Abbvie, ticker ABBV, has been a favorite here on the channel, not just for its 4.5% dividend yield, because Abbvie is also one of my favorite dividend kings, companies that have increased their dividends for more than 50 years straight. Now, I highlighted my favorites in a recent video, stocks with decades of dividend growth, so look for the link in the video description below. Abbvie is a best-in-class immunology drug company with a solid pipeline in oncology and eye care as well. The company has been able to grow its dividend by 6.7% a year over the last 5, but now before you get too excited, the share price has come under pressure lately. The big worry for Abbvie right now is its patent expiration on blockbuster Humira. Management is forecasting an 8% drop in sales this year and its third straight year of lower revenue next on those biosimilar drugs from other companies. It's going to be difficult keeping up those sales growth from the new drugs, but that's just the name of the game in pharmaceuticals. Abbvie does have a best-in-class pipeline with more than 20 indications in phase 3 or submitted applications. Sales of Skyrizi were up 80% on the year-over-year basis last quarter, and Rinvoq was up 50%. So none of this is going to keep the company from paying out those dividends, and the market fear has brought those shares back into value territory. You can see the shares go ex-dividend between the second and third week of January, April, July, and October, usually increasing the dividend in January of each year. Now, with these dividend stocks, there are 3 dates you need to know about if you're going to be investing. These are the declaration date, the ex-dividend date, and then the payment. The declaration date is when the board of directors in a company announces the dividend. Here, they're also going to tell investors when those other 2 dates occur. They can change this date each year, but they try not changing the other 2. The most important date for dividend investors is called the ex-dividend date. Now, that's the first day the stock trades without the dividend. And pay attention to that because it is very important. It means you need to own the shares on the day before that to get the dividend. So here, everyone that owns the stock on the close of market on the day before that ex-dividend date is going to get paid. If you buy the stock on that ex-dividend date or after, you're asked out. So make sure you understand this if you buy these stocks. Buy on that ex-dividend date, and you're still going to get those future dividends, but not the one coming up. And last here is that payment date, and that's usually going to be a couple of weeks after the ex-dividend date. This is when you're actually going to get that dividend payment in your investing account. Now, I've used the ex-dividend date here to make our weekly plan for this video because it's the one reported by Yahoo Finance. That means you're going to get the right to these dividends in those weeks that I'm listing here on the video, even if the actual payment doesn't arrive for a couple of weeks. It's all going to be the same though, because you're still going to be getting that dividend check every single week. Next, I've been picking through the wreckage of bank stocks this year, and I really like Citizens Financial Group, ticker CFG, with its 6% dividend. And this is a lot of the same argument that went into Lincoln National. Investors were surprised at that hit banks and insurance companies took this year after that year of rate increases. I think investors are going to be just as surprised over the next 2 years, though, when those rates start coming down and really lifts some of these same stocks. Before the crisis, deposits were up $26 billion last year, up 17%, though I expect a drop when Q1 is reported. The deposit mix is broadly spread out, though, seen in this pie chart here at the bottom, with just 28% in those demand deposits. So Citizens might not lose quite as much in deposits as some of the other regional banks. In fact, looking at this chart by Visual Capitalist, we see that Citizens has one of the lowest percentages of deposits uninsured. The average percent of deposits uninsured across all banks is around 51%, with Citizens here below US Bank, JP Morgan, and Goldman Sachs. Shares here go ex-dividend in the last days of January, April, July, and October, or the very first days of the next month. Citizens has been able to grow its dividend by almost 6% a year, though it has held it steady this year. When those interest rate cuts start coming through, I think CFG, along with a lot of the other banks, is going to see the improvement, and you could see some major dividend increases next year. Kinder Morgan, ticker KMI, hasn't done much on the price in a while, but there could be some great value here, along with the 6.7% dividend yield. Kinder is the largest energy infrastructure company in the S&P 500, with over 82,000 miles of pipeline, 140 export terminals, and a growing energy transition portfolio. You see here in the business mix scale at the bottom, the company is more heavily focused on that natural gas than most other energy companies. That could be a big upside as nat gas, LNG exports increase over the next few years. And what many investors like about KMI is it offers the opportunity to invest in these energy pipelines, terminals, and storage, but without having to deal with that K-1 tax form that comes with most master limited partnerships, or MLPs. KMI is a corporation, so it operates just like any other stock. More than 13% of the company is owned by management, most of that, over 10%, by founder Rich Kinder himself. Kinder has increased the dividend by 7% a year and usually goes ex-dividend towards the end of the month, January, April, July, and October. Now, I'm using this as our first week payment in February, May, August, and November, though, so there could be a little overlap between the fourth week and the first. I'm going to show you all these in a table towards the end of the video. Your second week payment then is going to be Duke Energy, ticker DUK, with its 4.5% dividend yield. Now, Duke serves over 8 million customers in 6 states across the Southeast and another 1.6 million customers for natural gas. Now, it won't make you rich, but this is definitely a slow and steady stock, with management forecasting 5 to 7% annual earnings growth through 2027. That earnings growth combines with the dividend for a 10% annual total return, a very solid return on a safety stock within regulated utilities. Duke is another one with some solid potential for price upside. Shares of utility companies are down almost 10% over the last year as those higher interest rates just draw investors out of these dividend payers into money market funds and T-bills. As rates come down, though, and make utility stocks more attractive, that price upside is going to supplement the dividend yield and growth in Duke. Here going ex-dividend in the second week of February, May, August, and November. We're halfway through our dividend stock list, but I wanted to make sure you know how I found these and how to use the strategy. Like we've talked about, most dividend stocks pay out each year on an extremely consistent schedule. Dividend investors love that certainty and the consistency, so directors of these companies try to declare and pay out those dividends on the same week every 3 months. Some even down to the same day. So what you can do, you can put together a list of your top dividend stocks. Then all it takes is going to a site like Yahoo Finance or any investing platform. You go to the stock, and here I'm going to go to the historical data tab. If I change the time period to the last 5 years and then over here to show dividends only, then the site is going to show me the ex-dividend date for every dividend payment over the last 5 years. You can see these are consistently the same time during the same months. Shares of AT&T go ex-dividend in that first week of January, April, July, and October, almost every single year. Now, once you have a list of when your favorite dividend stocks go ex-dividend, you can plan it all out on a spreadsheet like this to see when each stock is going to pay. Just pick one stock that goes ex-dividend each week 4 times a year. Now understand though that companies can change these dates, so you're going to need to watch and adjust this if you notice your dividend payments are off a little. I've highlighted shares of 3M, ticker MMM, and its 6.3% dividend recently on its upcoming spinoff. This stock has slumped 46% in the last 2 years on slowing sales growth and just a general market sell-off in these conglomerate stocks. Investors just don't want these big hodgepodge companies anymore. And 3M is just that, with its 4 segments from industrial products, which is about a third of total sales, to electronics, healthcare, which is about 24% of sales, and consumer products. While the company has increased the dividend for 64 straight years, it's only been at a rate of 2% annually over the last 5. Now, I do like 3M for a potential surprise upside that I'll tell you next, and the consistency in the dividends, but it's definitely not the fastest growing dividend. For that, check out the video I've linked in the description below, the fastest growing dividends in the aristocrats list. Stocks that have increased their dividends for 25 straight years. But now we come to the upside and why I think the shares get a bump this year and next. Like many conglomerates, 3M is spinning off its healthcare business into a new company by the end of the year. So if you own shares of 3M when that spinoff occurs, you're going to get shares of the new company automatically, and it could unlock some of the value buried in these other segments as well. While you wait, you're also going to be collecting that dividend around the 3rd week of February, May, August, and November. Shares of Whirlpool, ticker WHR, have pulled back to a 10-year low for a good value opportunity on top of that 6.3% dividend. Revenue has basically been flat over the last decade, and higher expenses have eroded its earnings. The company is still solidly cash flow positive, though, and sells some of the strongest brands in home appliances. But slower cost inflation, some expense cutting, and then renewed sales growth could take these shares back up over the next couple of years. And even under pressure, the company has continued to increase its dividend, here going ex-dividend towards the 4th week of February, May, August, and November. Like we saw with Citizens earlier, I also like Keeor, ticker KEY, and its 6.7% dividend yield. Now, Keeor is a smaller regional bank with branches throughout the Northeast and Northwest, and strong growth in its commercial banking segment, with C&I loans up 11% annually and investment banking fees up 15% on the year over the last decade. Now, that investing banking segment isn't something you usually see at these smaller regional banks, or at least not that kind of growth. I think it helps smooth out the risk in the bank's traditional loan business. Lower interest rates could see a turnaround in the stock price, along with that consistent dividend that you're going to get around the first week in March, June, September, and December from that ex-dividend dates late in the month before. We've still got 3 more weeks to cover, but there is one critical point you need to know about here when you're looking for dividend stocks to buy. Remember, dividends are taxed every year, whether you take that money or reinvest it. That can be a huge hit to your portfolio because the money you lose to Uncle Sam each year can't keep growing for you. Just look at what happens to $1,000 invested in Coca-Cola each month. Over 26 years, you pay almost $50,000 in taxes on those dividends, money that should have been yours to earn. Now, of course, the answer isn't to avoid dividend stocks, but to put them in retirement accounts when you can. If you don't need that cash flow right now, putting all your highest yielding stocks in a retirement account is going to save you that money. You won't owe taxes on the dividends until retirement, and that money is going to keep growing for you. Crown Castle, ticker CCI, and other real estate stocks are another group that have gotten hit on higher rates. But are we really using any less of the company's properties, more than 40,000 cell towers, and 85,000 miles of fiber optics cable? Of course not. Mobile data usage continues to grow, meaning growth in demand for towers. Mobile data demand is expected to grow 21% through 2027. Crown Castle is expected to post funds from operations of $7.32 per share next year, only slightly below this year's FFO, and is trading for a valuation well under its historical average. This, along with a lot of other real estate stocks, is purely an interest rate story. Higher rates sinking those property values for highly leveraged real estate stocks, and once those rates start coming down, we're going to see the opposite. It's another stock that could produce strong price returns on top of that 6% dividend, with the shares going ex-dividend in the second week here in March, June, September, and December. Now, this next one is going to be controversial, but I'm including Altria Group, ticker MO, with its 9.6% dividend yield. Now, I know a lot of you out there don't invest in these sin stocks, the tobacco, gambling, and firearms, but it's hard to pass up that consistency and the yield you get with Altria. Despite decades of fears that revenues are going to crash on regulations, this one just keeps on paying. The owner of the Marlboro brand in the United States is driving hard to a smoke-free future with heated tobacco and pouch products, and has been able to keep revenue consistent despite a years-long trend in lower cigarette volume. You can see here, even against an annual drop of 4% in cigarette volumes, the company has been able to stem that to just 1.7% on growth in its e-vapor and oral products. Altria also owns a 10% stake in beer maker Anheuser-Busch, worth $10 billion for some serious cash flow. Even on that continued drop in volume, Altria had the pricing power and the cash flow to pay down $1.1 billion in debt, still buy back $2 billion of its own shares, and pay $6.4 billion in dividends. That almost 10% dividend has grown by about 4% a year and goes ex-dividend around the third week in March, June, September, and December. I'll reveal that last dividend stock next, along with the complete dividend portfolio. But if you want to see the 7 dividend stocks that will pay your rent, check out this video in the corner. I'll show you the average rent by state and the stocks that will help you pay it. WP Carey, ticker WPC, is one of my favorite real estate stocks, not just for its 7.5% dividend, but also the properties it holds. WPC is a $17 billion REIT with great diversification across property type. In fact, pretty evenly spread across industrial, warehouse, office, and retail space. Most of the portfolio is in the United States, though it does hold just over 35% of its properties in Europe, which gives it some great geographical diversification as well. And it's really that diversification is why I like WPC as one of my favorite dividend REITs to start a portfolio. Against these other real estate stocks that I follow, only WP Carey has the exposure to different property types that I believe can really bring down the risk in your portfolio. The company collects over $1.1 billion in annual base rent and books 98% occupancy, over 131 million square feet, and across more than 1,100 properties. And with real estate selling off on those higher interest rates, this is another one with strong upside potential once those rates start coming down. Even against those rate hikes, though, the company still managed to increase its dividend and is going ex-dividend in that last week of March, June, September, and December. Here's the entire list of dividend stocks, 12 stocks that are going to produce a dividend check every week of the year. The dividend portfolio produces a cash payment over 6%, more than 4 times the stock market average, and these are stocks you can count on. Remember though, the dates can shift a little from year to year, so make sure you check this each year, or if you notice your weekly payments are off. See how you can get dividend income from rents on arrived homes and get on the waitlist with the link in the description below, or click on the video to the right for the 7 monthly dividend stocks I use to pay my rent. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.